The banking crisis in the US and Europe is still brewing. Experts reminded to maintain sufficient vigilance. Recently, the banking industry in the United States and Europe has been experiencing constant turmoil. After the crises of Silicon Valley Bank and Credit Suisse Bank caused market concerns, Deutsche Bank also became the focus of market attention. According to Wind data, as of March 27, Deutsche Bank's share price has fallen by more than 20% since March. According to public information, on March 24, Deutsche Bank's credit default swap (CDS) risk premium soared from 142 basis points on March 22 to 208 basis points, reflecting that the European market is still worried about the risks of the banking industry. On the same day, Deutsche Bank's stock price also fell more than 12% in intraday trading. However, as European leaders uttered their voices to calm the market sentiment, and the German IFO business climate data in March rebounded more than expected, Deutsche Bank's share price, which plummeted last Friday, March 24, also rebounded by more than 4% on March 27. The fact that the European market is so concerned about Deutsche Bank is inseparable from the important role it plays in the global financial system. Deutsche Bank is one of the 30 global systemically important banks identified by global banking regulators. It has an important position in derivatives, foreign exchange transactions, and international bond markets, and is therefore generally regarded as a too-big-to-fail financial institution. Yang Haiping, a researcher at the Securities and Futures Research Institute of the Central University of Finance and Economics and general manager of the Research and Development Department of the Bank of Inner Mongolia, analyzed in an interview with a reporter from the Securities Daily that Deutsche Bank, as a financial institution that occupies an important position in global derivatives transactions, holds some the risk of investment portfolio is higher, which is noticed by the market. However, the current market generally believes that the real reason why Deutsche Bank became the center of the storm may be that sensitive market sentiment and a crisis of confidence in the banking industry were precisely directed to Deutsche Bank. As Yang Haiping said, in fact, the deep-rooted reason for the market's concern about Deutsche Bank can be traced back to the current economic situation in the United States. According to Xinhua Finance News, as the Federal Reserve continues to raise interest rates and the interest rate has risen rapidly, investors' concerns about the default of U.S. real estate loans have increased significantly in recent weeks, with a roughly $16.8 billion portfolio involved in U.S. commercial real estate. Deutsche Bank has one of the largest exposures in Europe to the sector, according to research data from financial firm Autonomous. However, as far as Deutsche Bank itself is concerned, its pre-tax profit reached €5.6 billion last year, a year-on-year increase of 65%, the highest level in the past 15 years. And research institutions also believe that the above-mentioned high-risk assets are equivalent to 35% of the bank's core capital, and the risks are controllable. The sharp drop in stock prices may be related to short selling by hedge funds. According to Mingming, the chief economist of CITIC Securities, there is a certain risk of default in this round of U.S. commercial real estate, but if the U.S. economy can continue to maintain resilience, the risk of default may be controllable. Mingming further stated that, in addition, it is difficult for the Federal Reserve to cut interest rates, which will cause high interest rates to continue to negatively affect bank operations from the liability side and the asset side, especially small and medium-sized banks. Although the bailout policy introduced by the United States has injected certain confidence and liquidity into the market, it is expected that it will be difficult for the Federal Reserve to cut interest rates, which will constitute a continuous headwind for the U.S. banking industry. It is expected that the U.S. and European central banks will be more cautious in their tightening pace, and the uncertainty of their tightening path will be higher. The liquidity test and trust crisis in the U.S. and European banking industries are still brewing, and the possibility of risk contagion is still relatively high. It seems that a bigger storm is still brewing. We must maintain sufficient vigilance against this, Yang Haiping said.